Welcome back to the Deep Dive. Today we're jumping right into Hamilton Lane's fiscal Q2 2026 results. That's ticker HLNE, period, ended September 30th, 2025.
Yeah, and this call happened November 4th during market hours. The market definitely noticed.
It certainly did. So this wasn't just a standard beat. It felt like it really sharpened the focus on their long-term growth path. Predictable, sustained growth seems to be the story.
Exactly. If you're tracking private markets, HLNE is, well, it's a key name. And what they laid out, it wasn't just about the numbers beating expectations. It really solidified the narrative around durable fee income.
Okay, yeah, high-quality fee-led scaling. Let's get the snapshot first, because clean sweep feels like the right description here.
It really does.
Non-GAAP EPS, $1.54. The street was looking for something like $1.12.
Yeah, so that's a beat by $0.42, almost, what, a 43% surprise? Huge.
That's massive, and the top line didn't disappoint either.
No, revenue hit $190.9 million, again, well ahead of expectations, and that's up 27% year over year.
Okay, strong growth. But you mentioned the quality of earnings. Let's dig into that. Fee-related earnings, the FRE.
That's the number to watch. $77.0 million. That's up a huge 37% year over year. That's the core engine fire.
37% growth in the most predictable part of the business.
That's impressive. What about the margins on that?
Even better, arguably. The FRE margin hit 50% this quarter.
50%.
Yeah, 50. Up from 46% in the same period last year. So for every dollar in those management fees, half of it is dropping to the bottom line. That's real operating leverage.
And that includes some benefit from fee-related performance revenues, the FRPR, right?
It does, yeah. But the main takeaway, like you said, is investors clearly see this incredibly durable, high-margin fee engine. And, well, they seem to be valuing that stability much more than trying to guess when HLNE might sell assets and realize carry.
Right, that timing is always tricky. Okay, so that stability is built on scale. They hit a big number this quarter.
They did. The total asset footprint, that's AUM and AUA, combined crossed $1 trillion for the first time. $1 trillion. That's a significant number, psychologically and competitively.
Absolutely.
But let's narrow in on the part that actually earns those fees. Fee-earning AUM.
Right, the key number. That stood at $76.4 billion. Grew 10% year over year.
Okay, 10% growth there. But what's interesting is how the price they charge, the fee rate, is changing.
Yeah, that's a crucial piece of the story. The blended fee rate hit 65 basis points.
65 basis points, and that's up significantly since the IPO.
It is. Up 14% since they went public back in 2017. And that's not by accident. It's a direct result of them shifting the mix towards these higher fee specialized funds, especially the evergreen products.
Ah, the evergreen funds. Seems like that's where the real momentum is.
Absolutely phenomenal momentum. The evergreen platform had its biggest quarter ever for net inflows, pulled in $1.6 billion.
Wow, $1.6 billion in one quarter.
Yep. That pushed the total evergreen AUM up to $14.3 billion. They basically doubled the size of that platform in just the last 18 months.
Doubled in a year and a half. That suggests they're getting much faster at launching and scaling these things.
That's exactly what management highlighted. They've cut the time significantly. You know, the first few evergreen funds took almost 2 years each to get to $500 million in AUM.
Yeah.
Now, new funds like global infrastructure, secondaries, they're hitting that same milestone in under 12 months.
So it's like they've built an assembly line for these products now.
Pretty much. The flywheel is definitely spinning faster.
And there's a kind of baked-in revenue growth coming too, right? From assets turning on fees.
That's right, the fee holidays. When they launch these, sometimes there's an initial period where they don't charge fees. Right now, there's over $1 billion in evergreen AUM that's not yet earning fees because of that.
Okay, $1 billion not earning fees yet.
But management said over half of that billion is expected to switch on, become fee earning by the end of this calendar year, Q4 2025.
So that's near-term visibility on more fee growth already locked in, essentially.
Exactly. Very clear visibility.
Okay, evergreen is booming. What about the traditional institutional side, the separate accounts, the SMAs? That growth looked a bit slower.
Yeah, SMA AUM grew about 4% over the last year.
Should we worry about the core institutional business slowing down?
I don't think worry is the right word. It's more about recognizing a strategic shift. Management was clear. The institutional pipeline is strong. Billions in dry powder waiting. But often these specialized funds, including the evergreen ones, are just a better fit for clients now than a fully custom SMA.
So it's not necessarily slower demand, it's them guiding clients to different, maybe more scalable products.
Precisely. It's an intentional optimization towards those higher margin scalable fund structures. Less bespoke, more standardized, but still specialized.
Got it. Okay, so strong operations, accelerating evergreen. But the other big news was the Guardian Life partnership, announced right around the earnings.
Yeah, this is potentially the biggest strategic catalyst. HLNE is now the core strategic partner for private equity for Guardian Life Insurance Company of America. Big deal.
Core partner. What does that actually mean in practice?
It's got a couple of parts. First, Mandate 1. HLNE takes over managing and monitoring Guardian's existing PE portfolio. That's nearly $5 billion. Initially, more of a monitoring job.
Okay, taking over an existing book. But Mandate 2 sounds like the growth engine.
That's the one. Mandate 2 is a commitment from Guardian to invest about $500 million per year for the next 10 years.
$500 million a year for a decade. That's $5 billion in committed capital flowing in.
Exactly. Predictable, long-term capital deployment. And it'll be managed through a separate account, but importantly, it includes significant allocations into HLNE's own funds.
And boosting evergreen specifically.
Big time. $250 million of the early money is going directly to seed and accelerate the global evergreen platform. That's huge institutional validation right there.
Okay, Guardian's a massive insurer. Is this deal just about the capital, or is there more to it, like distribution?
It's definitely both. But the distribution piece, that's the really smart capital-light win for HLNE. Guardians get some warrants in HLNE stock, less than 1% dilution expected, and some revenue sharing tied to that seed capital.
Okay, small price to pay.
For what they get in return.
Yeah.
Access. Immediate, deep access to Park Avenue Securities. That's Guardian's broker-dealer network. We're talking 2,400 advisors.
Wow. So overnight, HLNE plugs into a massive network serving insurance clients and high net worth individuals.
Exactly. It supercharges their reach into those channels without needing to build it all from scratch. Huge efficiency gain.
And speaking of efficiency, they're getting people too.
Yeah, the deal includes transferring Guardian's PE team over to HLNE. So they get the expertise needed to manage this big mandate, likely offsetting a lot of the need to hire externally keeps things lean.
Okay, so the Guardian deal locks in capital and distribution. Very powerful. But what about getting money out? The realization environment. You mentioned carry earlier.
Right, the flip side. The unrealized carry balance is healthy, about $1.4 billion, up 14% year over year. So the potential is there.
But timing is still fuzzy.
Management used the word unpredictable, which isn't surprising given the M&A and IPO markets are still, let's say, selective.
Yeah, seems to be the story everywhere. But they sounded pretty confident about the underlying health of private credit. They pushed back hard on that crisis narrative.
It really did. Spent quite a bit of time on it. Basically said, look, the popular narrative of a widespread private credit crisis, we see zero data supporting it in our universe.
Zero data, that's a strong statement. Are they just trying to reassure investors, or do they really believe their data gives them a clearer picture?
They argue their data is the clearer picture. They pointed to their huge proprietary database covering something like 65,000 funds. Their view is the crisis talk is based on a few high-profile bankruptcies, basically anecdotes, not broad trends.
Okay, so what are the broad trends they see in their data?
Well, first, leverage. They said leverage in their portfolio companies is around 5 times EBITDA. Importantly, that's down a full turn since 2022. So de-risking has happened.
Okay, lower leverage. What about the ability to pay the interest?
Interest coverage, they said, is healthy at 2.8 times, meaning companies generally have enough earnings to cover their interest payments comfortably. That's actually up half a turn over the past 2 years.
Lower leverage, better coverage, and the default rate.
This was key. They said the default rate is running around 1%.
1%.
1%, which is, well below the historical average for private credit, which is closer to 2.5%.
So their message is, our data, covering tens of thousands of funds, shows prudent leverage, good coverage, and very low defaults. No crisis here.
Exactly. And that data transparency itself becomes a selling point.
Right. And they're leaning into that data authority with other initiatives too, like the Bloomberg partnership.
Yeah, that's a smart move. They're partnering with Bloomberg to put a whole suite of HLNE private market indices and benchmarks right onto the Bloomberg terminal.
Does that make them money directly?
Management said near-term revenue is modest. The real win is massive brand enhancement and visibility. Think about it. Every RIA, every institutional investor using a Bloomberg terminal now sees HLNE benchmarks as the reference point for private markets.
So it cements them as the standard setter, the authority, even if they're not planning investable index products right now.
Correct. They were clear. It's about education and establishing that definitive neutral standard. It just draws people into their ecosystem.
Makes sense. And they also updated on some strategic investments they've made from their own balance sheet. Securitize.
Right. Their investment in Securitize, the tokenization platform, looks like it's paying off. Securitize is set to go public via a SPAC, probably in the first half of 2026.
Okay.
And the proposed valuation, it implies HLNE's stake is worth more than double their initial investment. So it validates their strategy of using the balance sheet, not just for pure financial return, but to get stakes in tech that helps their core business.
And they put more money into Nevada, linked to Atlas metrics, more data play.
Yep, expanding their sustainability data capabilities. Another example of investing in data and analytics across the private markets landscape. It all fits the theme.
Okay, wrapping up the financials, dividends.
Solid signal there. Board declared the $0.54 quarterly dividend. And importantly, management reaffirmed the full fiscal year 26 target of $2.16 per share.
Which is a decent increase on last year.
A 10% increase over fiscal 25. So even without giving formal profit guidance, which they never do, they're signaling pretty high confidence in the cash flow continuing to roll in.
Okay, strong message on cash flow confidence. That's so good. All right, now for the part of the deep dive you've been waiting for. It's time for our segment. This is not financial advice. Over to you for the outrageous but plausible trade idea based on this HLNE quarter.
Okay, thanks. So thinking like a hedge fund analyst pitching the investment committee. The story here is all about predictable growth, fee stability, and a huge distribution win with Guardian. It's about de-risking growth.
Right.
So the trade idea is a classic pairs trade. We go long HLNE, and we short, well, we find another alternative asset manager, specifically one that's much more reliant on volatile performance fees, the carry, or maybe one that's publicly struggling with raising new closed-end funds right now.
So betting on HLNE's structure versus a competitor's more volatile or challenged model.
Exactly. You're betting that HLNE's annuity-like fee-related earnings, supercharged by that decade-long Guardian commitment and the evergreen machine, will just grind higher, delivering superior relative performance over, say, the next 12 months. You're choosing FRE stability and that distribution unlock over trying to time the carry cycle or navigate fundraising headwinds elsewhere. It's a bet on the quality of the business model, really.
Okay, so pulling it all together for you, the listener, what's the big takeaway from this Hamilton Lane quarter?
I think it's that they delivered operationally, no question. The evergreen platform is really hitting its stride. But the Guardian deal, that's the strategic masterstroke. It's capital-light distribution and locked-in future fundraising.
It really seems to de-risk a big chunk of their growth plan.
It does. And connecting it back to that pushback on the credit crisis.
Yeah.
If HLNE really does have superior data and visibility, as they claim,
Yeah.
then the provocative question becomes, can they use that visibility, combined with the guaranteed Guardian capital flow, to deploy that $500 million a year faster and more profitably than their competitors who might be more hesitant or flying blinder?
So it's not just about getting the capital, it's about the speed and confidence of deployment based on their data edge.
Exactly. That deployment velocity, fueled by Guardian and enabled by their data insights, that's the next thing you really want to watch closely.
Excellent point to leave things on. Thanks for joining us for this deep dive into HLNE.